Welcome to the Florida chapter of American Academy of Pediatric Trainees Tips, an educational series for pediatric trainees offering advice on topics of interest identified by medical student, resident, and fellow members of the Florida chapter of the American Academy of Pediatric. I'm your host, Isa Hanna, a third-year pediatric resident at University of Florida, Jacksonville, Florida, and a member of the Florida chapter of American Academy of Pediatric Resident and Trainees Committee. In this session of the Florida chapter of FCAAP Trainees Tips, financial advisors Mr. Matthew Davis and Mr. Bryson Bard of the Northwestern Mutual Wealth Management Company will target both opportunities and deficiencies that most aren't aware of that may need to be addressed before choosing a post-residency or post-fellowship employment opportunity. Bryson and Matthew hope to increase awareness of strategies and laws to exploit the best cost outcome of your household student loan debt. Please note that financial planning should be addressed on case-by-case basis by a professional to make sure these principles fit into your specific circumstances. Matthew Davis is a financial advisor practicing since 2012. He's a University of Florida alumni and Army veteran that's passionate about financial literacy for physicians and tailoring specific plans for their households and practices. He recently married his wife, an OBGYN, in his front yard due to COVID restrictions. Hobbies include visiting national parks, playing with his dog, and staying in his wife's good graces. Bryson Bard is a certified financial planner and fiduciary who specializes in comprehensive planning and tax strategy for physicians and businesses owners. He has been an advisor for the past 10 years and has clients in over 30 states. His team of 6 coordinators coordinates the moving pieces of clients' lives into one cohesive plan and recommendations. Bryson and his wife, Krista, has 2 children, Isaiah and Elizabeth, whom they love to take exploring trails in town, reading books, spending time with the church community, and traveling in the non-COVID era. Lesser known facts about Bryson would be his passions for botany, ultimate frisbee, and a minor in Arabic from college. Now I will turn it over to Matthew and Bryson.
Thanks for the introduction, Dr. Hanna. As he said, this session is about comprehensive financial planning. I'm Matthew Davis here with Bryson Bard. I'm going to ask some questions that Bryson and I hear on a daily basis from our resident, medical student, and fellow and young attending clients on a consistent basis. So let's start with question number 1. Bryson, I'm going to make much more money as an attending. What do I even need to focus on right now?
There's a lot of things that you can kick down the road to focus on as an attending. There are some things in residency that make sense to focus on. Specifically, when you look at comprehensive planning, there's a lot of moving pieces of now that you have income from the investments, the insurance, the short-term savings, the student loan management. So a couple things that we think you should definitely do. One is build a comprehensive plan with a fiduciary planner who's got those moving pieces both now and in the future. The other practical thing is during residency, you're paid less, which many residency isn't a reason why they shouldn't be planning, but frankly, it's in many ways a reason why you should. There's significant opportunities from a tax standpoint and from student loan planning that having a lower income is advantageous. So we'll talk a little bit more about that, but those are a couple of things that come to mind for sure that you should focus on during residency.
Okay, here's a question I hear pretty often. I'm sure you do too, Bryson. I'm not sure if I have enough or too much money in my savings account. What do you recommend? What is the right amount of savings to have built up while I'm a young attending or a resident?
Right. Well, if you have too much in your savings, that's great. That's usually not the issue, but we definitely help people that have that situation. But the CFP board would generally recommend between 3 to 6 months of expenses. Less than 3 months can leave you exposed to things that might pop up, exams that you need to take, or boards. Having more than 6 months might leave efficiency on the table, that you could be more efficient with those dollars. That's a general rule of thumb. Your situation might differ depending on saving for a down payment or other short-term goals you might have.
Okay. Here's another question I think we should throw out there that we hear quite a bit. You know, most residents have a lot of student loan debt. 200,000 plus is pretty typical. Should I even consider investing while I'm a resident, or as I start my career as an attending while I still have these loans?
Yeah, the question of investing or paying down debt with extra money, that's a question we get quite a bit. And is it even worth it? And there are a bunch of factors that go into it, but ultimately paying down debt or investing, and when I say debt, this could be student loans, but this could also be credit card debt or other higher interest debt that clients might have. If you have an extra dollar that's not going towards bills, the question is, what's the most efficient thing that you can do with that dollar? And so if you pay down debt, you're going to save interest on that dollar based off the interest rate. So if you have 20% credit card debt, for every dollar you pay down that credit card debt, you're going to save a guaranteed 20% interest. Whereas if you invest the money, you could get more than that. You could get less than that. On average, we might earn 7, 8, 9, 10% return in an investment long term, but it's not guaranteed by any means. And so having high interest debt, paying that down first and getting a guaranteed 20% is fantastic. When you start looking at student loans, there's a couple other variables. One is there's concepts of, are you going for loan forgiveness? If so, that even if you have interest, it may not ever be something you end up paying. There's also there's interest subsidies, which we'll talk about a little bit later. But even if your interest rate is at 6.8%, you might not be paying all of that because you could have that subsidized. And then as far as the other benefit would be taxes. You're in a low tax bracket now, and so some investments you can have benefits of investing now where you're in a low bracket. And so paying off student loans versus investing, at the end of the day, we do have many clients that do some basics of investing even while they have loans, especially if you're considering public service loan forgiveness.
Great, yes. Here's another question. How should I invest my money?
Yeah. So if you are going to invest your money, residents are probably going to target two things primarily. The first investment they would want to put money into is any match that an employer might give you. So not matching like the match list, but we're talking about 401k or 403b match. So in a retirement plan, if a resident gets a matching program, if you put in 3% and they're going to match you 3%, they just doubled your money. You got a 100% return day one guaranteed. There's nothing anyone else can give you in return like that that's going to match it. So even when we talked about paying down, student loans, if student loans are at 6% and you just got a 100% return by doing your 401k match, we would absolutely recommend that. Once you've done up to the match, any additional dollars may or may not be beneficial. After the match, most people will then max out a Roth IRA. A Roth IRA is a tax-free investment, which means we go ahead and pay taxes now at your lower bracket, as a resident, but we'll never pay tax again. We can put up to $6,000 in that account. And if that $6,000 grows over the next 30 years, and let's just say that it grows to $100,000, we'd owe no tax on the growth of that account. So paying it now at your lower tax bracket is, many clients will try and max those out during their residency. One other thought, the Roth IRA has some added benefits over a Roth 403B, because there are such things as Roth 403Bs. The Roth IRA, you can actually pull money back out, what you've put in, without a penalty, up to your contribution. The growth is what we have to leave in there till 59.5, whereas the 403B, we really can't touch any of it. It's pretty illiquid, or else we pay a 10% penalty on top of tax.
Okay, great, thank you. All right, let's talk about student loans. What's the easiest way to tackle those? How do I get rid of that? I mean, it keeps me up at night watching the interest compound on it while I'm in training. What's the best way approach to tackle student loan debt?
Yeah, so when you're looking at student loans, and I guess I should mention, we're going to cover it a little bit in this topic, but we have another whole section specifically on student loans. So definitely go there for more detail. But the couple main points with student loans you want to consider is, one, which repayment plan. So there's the standard repayment. You could do forbearance. You could refinance your loans, or what most people do is an income-driven plan. Of the income-driven plans, there's multiple options like income-based repayment, revised pay-as-you-earn, pay-as-you-earn. And these are actually highly complicated. They're actually one of the most complicated. I was talking to an IRS auditor or agent, not sure exactly what his role was, but says the amount of factors that go into student loan planning is one of the most complex they have. And it's because when you look at your loan payment, the factors are, how much income do you make? How much did you make last year? What does your spouse make? Are you working for a for-profit or a nonprofit? These are all different factors that go into which repayment plan is going to be best for you. And so repayment plan is specific that you want to focus on. A key point we'd probably say is the repay program. If you don't have a high income earning spouse, because it'll include their income, repay oftentimes can be efficient for physicians, for residents specifically, because there's a unique aspect called an interest subsidy. So any payment you make during residency, if there's interest above and beyond that, which 95% of residents, that's the case, any unpaid interest gets a 50% subsidy. So let's just say you have a $200 payment that's $2,400 a year, and your annual interest is $12,400. To make the math easy, there's $10,000 of unpaid interest. Under repay, only $5,000 of that would capitalize to add to your loan, and $5,000 would be forgiven, would be subsidized that year. So whether you're doing, this is important actually to keep in mind, this doesn't matter whether you're doing public service loan forgiveness or not, the subsidy would benefit either way. And so that's oftentimes a beneficial situation, because if your interest rate was at 6.8% with a 50% subsidy, it might be closer to 3.5 or maybe 4, which is frankly comparable with a private loan anyway. So, I mean, that's one. Okay. I think I'll look at my notes. So, I think that's all we'll cover in this one. There's a lot more detail, including some of how the Biden administration might affect changes to student loans. So be sure to check that out.
Yeah, see the other video for more details. Thanks, Bryson. So another thing that myself and even my wife, who's an OBGYN, we hear a lot from the residents in her program and the clients we work with, is they get a lot of emails about disability insurance. A lot of mailers, in their mailbox. They already have that at work. as a new attending or even as a resident, there's disability insurance. So why are we getting so much information or bombarded by these products?
Well, so almost every program, probably 95 or more percent of the programs have a group disability program. And that's a great benefit. It's usually not going to cost the resident anything, but it protects a portion of your residency pay. When the purpose of disability is actually to protect your entire earnings potential, which is far more than you're making as a resident over a much longer period of time. So let's just say, for easy math, we'll say that someone makes $50,000 as a resident. To divide that by 60%, a 60% disability through your group would cover $30,000 a year. That's $2,500 a month. But additionally, because the employer paid for it, you'd have to pay tax on that $2,500, which means if you were disabled and unable to work, you'd walk home with $2,000 a month. $2,000 a month is difficult to pay bills, much less pay down any debt, like because we're still on the hook with the student loans. Student loans can be forgiven in very extreme situations, that basically if you have Social Security disability qualifications, which means you can't do absolutely anything, and it's usually after a long drawn out process. But so for the most part, $2,000 a month is probably not sufficient. The good thing is it's quite cost effective, actually, especially for pediatricians, to get additional disability. So supplemental disability coverage, insurance companies know that you're worth well more than you're paid as a resident. And so you can get an additional $6,000 a month on top of your group coverage, which would give you closer to $8,000 a month if you were disabled, which feels like $100,000 net, which would be about $120,000 salary. So that's a lot more realistic if you wanted to have some type of lifestyle for all the hard work you put in. But most physicians don't realize, I think, with disability in general, or just their income, they've worked really hard to get to this goal, and to make, let's say, $200,000 a year is $1 million every 5 years. Over a 30-year period, that's $6 million with no inflation. If we adjust for inflation, they're going to earn over $10 million of income. How do we make sure we protect that income stream? So we do focus a lot on disability. Most attendings are going to encourage younger docs to look into that as well, just because your income is something we can't afford to lose.
So as a resident, how much could I get?
So pediatricians can get generally around $6,000 a month. Other
in addition to what they have at work. Okay.
Yeah, on top of what they have through work, and then so other specialties can get $7,000 or $8,000. Maybe if you subspecialize, you need a little bit more. It depends a little bit. Basically, the longer the specialty, the higher the earnings potential after, the more an insurance company will insure you for during now. And you can also buy the ability to buy more, so that if you say, well, I'm going to make more as an attending, you can buy what's called an additional purchase benefit to add that option, which locks in your health status now. So.
Okay.
Yeah.
Okay, cool. So this is a lot of information. What would be the best starting point? What should be my first steps?
Yeah. Well, we talked about it at the beginning a little bit, but the biggest thing we'd say is viewing this as a comprehensive plan. And we went through each section, but again, there are 4 planning categories. There's the short-term savings, the long-term investing, the student loan strategy, and there's the insurances. So those are kind of the 4 planning quadrants we focus a lot on. But we would encourage all of our residents, all of our attendings as well, to really look at this as a comprehensive plan, to work with a fiduciary planner to build a projection of your current situation going forward. Because how you do your student loans is directly connected to how much you're saving for the down payment on your house, and how much should you invest is connected to, are you single or married? And so we would encourage you do a comprehensive plan. We do complimentary consultations, and so our information will be up at the end of this. But at the end of the day, you've spent a lot of time. All of these residents, you guys have all spent a long time to accumulate specialized knowledge in your field. and just to work with other specialists, like a certified financial planner who can help you do that going forward. But hopefully there's enough initial recommendations today or ideas that might get you started. And as a CFP, I'm a fiduciary, and so I might as well go ahead and say that none of this is specific advice for any individual. You should seek a specific plan yourself. Just the reality, just because this may not be specific to your situation.
Well, thanks, Bryson. A lot of great information. Thank you. At this point, we'd like to thank Dr. Hannah, and thank you all for listening to this episode of FCAAP Trainee Tips. I'm Matt Davis, and that was Bryson Bard, and we appreciate your time.